Alright, so in this video, we are going to talk about the liquidity pools, and we're also going to go in depth about the market structure concepts. But basically, what we have here is the core concept of our trading, which is going to be, again, the liquidity pool. I have to mention that I've recorded this video once, but I've deleted it by mistake, and I'm just remaking it right now. And it is a pain in the ass, but whatever. First of all, prior to getting familiar with the ins and outs of the liquidity pool, I want to remind you of the continuous and ongoing war between smart money versus retail money, where awareness of how the mass thinks and capitalizing on it makes us be a part of the smart money capitalization. Liquidity pools. Definition. The liquidity pools, defined as sell side or buy side, are defined levels where retail traders place their stop losses, serving as a point of accumulation or distribution for smart money entities. So the liquidity pools, if we're going to understand the logic, and this is why you join this mentorship, to understand the logic of everything that we know as an ICT concept, these liquidity pools are going to be used for smart money accumulation. So we know that smart money pairs their orders with existing sell stops or buy stops or stop losses from retail traders, and then we distribute above, again, pairing our orders with their existing stop losses. This means that where retail money sees a support level, which is defined by equal lows or relative equal lows, we see that as sell side liquidity. In the same time, this can also be seen as a means of a singular swing low. Where retail money sees a resistance level, which is defined by equal highs or relative equal highs, we see that as buy side liquidity, which again can be defined as a singular swing high. Right here, we have a 15-minute chart of the NASDAQ. What we have here is a simple annexation of the levels of liquidity pools. We have the level of sell side. We have also a level of buy side above the market. We have this low right here, which is relatively equal to this one, which is relatively equal to this one. And then we also have this level of sell side, which is going to be a single low sell side liquidity pool. Same time, we have this here. And the reason why we care about this or these levels is that we know that retail traders will place their stop here. And the way in which they're going to behave is going to be the following. We're going to have them thinking that this is going to be a support level. So when the market goes to it next, they think that they're going to see the market going higher from it, and they're going to see this level holding. Same thing goes with this one. And then we also have the breakout traders, which they cannot wait for this quote unquote support level to be broken, and they're going to go short on this breakout. They're going to have their stop losses around here. And then we're going to also capitalize on these people. So we as smart money, we understand the fact that we want to accumulate our longs right here. And if the market accumulates longs instead of this higher time frame key level in which we were already anticipating the market to go higher, then we want to distribute them where? Above a means of a buy side liquidity pool, or an opposing, in this case a buy side, but an opposing liquidity pool. We have also annotated right here that the market shifts from a sell program into a buy program, and I want you to remember this when we go and talk about market structure. But basically, why I chose this high was for the sole purpose of this high was the one that sent price lower into these levels of sell side, which is the high that it is. This high is important because this, again, is the one that sent price into sell side. So when the market goes above this one, as we've had underlying weakness, as we've had the market going back to the downside, this shift from a sell program into a buy program. And what I want you to understand here in terms of market structure is that we're going to have clearly defined swing points, clearly defined market structure in terms of, oh, this is an intermediate term low, this is an intermediate term high, this is long-term low, etc. But we're going to also understand the fact that market structure can be determined by extension of understanding institutional order flow signatures. For instance, because we go above this high here and the market shifts from a sell program into a buy program, I would never want to see the market go back below this low. Indeed, this low is going to be something that we're going to talk about in terms of market structure, but essentially, you can see how we do not want to see the market go below this low just because we did the market structure shift. And this is not something like, oh, this is an intermediate some low because of this. This is not a rule set. This is derived from the fact that we shifted. A big difference. And we're going to have the liquidity pools and market structure introduction, where we discussed about market structure, or when we discuss about market structure, it is very important to understand what lows and highs will be taken, as well as it is equally important to understand what lows and highs are not going to be taken. And we are going to correlate our understandings of liquidity pools and inefficiencies to do that. And as promised, you're learning the logic and not a do this or do that. So I never tell you only do this. I never tell you do this because why not? I give you the logic, which is exactly what I've guaranteed when you joined this mentorship. Here we have the clear depiction that we've had in terms of the last lesson. We have the swing high, and this swing high is a pattern, if you want to call it like that. It is a 3 candlestick formation where we have a highest high, the lower high to the left, and a lower high to the right. This is called, plain and simple, a swing high. And for the opposing, this is going to be a swing low. And let's just take, for instance, a bullish scenario because we never talked about the swing low in itself. When we anticipate the market to continue higher, I want to see these swing lows to stay in. And of course, there's going to be context that is required for that thing to happen. Because we can have swing lows, we can see swing lows, but if we do not have the right context, if we do not have the right bias, if we do not have the right narrative, these swing lows are going to be just, for a short time period, and then they're going to get they're going to have the market go through them. Because everything that we talk about inside of this mentorship is context based. So if the context is not correct, then these things are not going to work. If the context is not right, again, I'm going to repeat this, nothing is going to work. Because if you're looking for bullish price action and have no reason for said bullish price action to occur, then of course you're going to see swing lows. But those swing lows are not going to be swing lows that stay in. Those swing lows are going to be swing lows that are going to be used as a means of sell side, which means that the market is going to go through them. The purpose of these swing points is to highlight the market finishing a retracement and signaling the beginning of the expansion. The swing low is also used as a sell side liquidity point in an opposing scenario. And right now, let's just get right into the smart money market structure. And when I talk about smart money, I do not talk about the general public or what the general public calls smart money, because there's a lot of videos on YouTube where they talk about smart money and they talk about the demand and supply zones, which is absolutely asinine. Like, there's no supply and demand when you're talking about smart money. That is a retail concept. They also have, I don't know what they have, but we're going to talk about the ICT concepts. We're going to talk about the smart money approach or the smart money perspective. And I'm going to remind you that nothing will work without context, which will be learned integrally throughout month 2 and month 3, and is going to be mastered really through month 6 and month 7, or even month 8, or even year 2, if you are going at the right pace. But I want you to understand the fact that if you take all of these things that we're going to talk about, all of the signatures that we're going to talk about, if you take every singular concept that we talk about and you have no context, then it is not going to work. You can learn everything how you want. It is not going to work. Let's start out with the market structure shift. Definition. The market structure shift is a short-term shift between an ongoing previous sell or buy program into the opposite. So for instance, the market has been going lower, reaching a higher time frame key level from which we already anticipate the market to run higher. So the market goes back into this higher time frame key level we wanted to see the market go into, and the first sign of the reversal will be seen with a lower time frame market structure shift. So for instance, I'm looking for a daily chart to go back into a busy. And then once the market reaches that busy, I'm going to wait for a 15-minute market structure shift to know that the market has successfully went back into the busy and we are starting out the expansion to the upside. The market structure shift is created when the market runs above or lower the opposing swing high or swing low that created the run lower or higher. And right here, we have a clear depiction that I'm going to pull up more times inside of this lesson. What we have here is the market going up, the market going lower, below a means of a sell stop, or this is a place where the market or retail traders will have their stop losses. The market, not the market, but smart money accumulates longs. Smart money pairs their longs with their existing shorting or the sell stops. So these people are losing for us to get inside of a position. And this right here is also a higher time frame key level that we were aiming for. And note the fact that we are also going back inside of this range. We're going back into this level. We're going back, if we're going to look at this, to this. This is lower than this. This is a lower price than this one. And I want you to understand this because this is going to be important in the next minute. So if the market went lower, and we understand the fact that this here, and I'm going to also talk about what a dealing range is, but pay attention. If we're looking at this dealing range or this run from this swing high here, which is going to be seen as a swing high in terms of a normal chart, down to the swing low, if we understand that this run was created for the sole purpose of retracing back below these sell stops, if we understand that, then once we go above it and once this high is taken, then there is no reason for the market to retrace back with such degrees of, or to create a deep retracement, because this is now done. Smart money has successfully accumulated longs. The market has shifted from a sell program into a buy program, and now we're looking for higher prices. For this lower time frame inefficiency or liquidity pool, for this higher time frame key distribution level in which we ultimately want to see the price go, and then we have something here which I'm going to discuss with you. But the premise that I want you to understand inside of this is that I'm going to look for a market structure shift with the high that has created the low below the sell stop rate. So we have this. This is the swing high that created this low. This is the swing high before the impulse going to the downside. So this, if I anticipate the market to go higher from this price point, then if the market goes above this swing high, it is going to be labeled as a market structure shift. And then I'm going to never expect the market to go back into a deep retracement between this low again and this high. Reason being is because we accumulated here. We have their stop losses here. I'm going to remind you that there's going to be people that short a breakout. So they're still going to have stop losses, or they're not going to have any stop loss at all. So we do not want these people to really mitigate their loss. we want these people to suffer even a bigger loss, and we do not want them to minimize their loss. That is why I never anticipate the market to make big retracements once we shift the market structure. Going on to the next thing we're going to talk about, which is going to be the premium discount. Firstly, the dealing range is a specific range of price created by a previous price run in which we are currently trading. So exactly as I've stated before, when we're going to look at the dealing range, we're going to talk about a specific range, and we're going to look at the extremes. We're going to look at specific swing lows and swing highs, and the ones that we're going to look for are the ones that are going to be they're going to be the ones that take other swing highs and lows, exactly as I've explained to you in the previous example. And if we take said range and we're going to apply a fib, we're going to get the following level. We're going to have the 50% level, which is going to determine whether the market is going to trade inside of a premium, which is within the upper 50% of that range. The equilibrium, of course, is going to sit at the 50% of that range, and then the discount is going to be lower than the 50% of that range. What I also want to talk about here is the fact that the premium discount it is not only linked to a dealing range. For instance, if we're going to look at where the market trades in relationship with the daily New York opening price, or the price that is at the New York midnight opening, if the market trades higher above it, then that is going to be the market trading within a premium. Or for instance, if we're going to look at the price action with a vertical line at 8:30 in the morning in New York time, and then the market trades lower than the 8:30 opening, then that is a discount. So this is not a premium discount in terms of a dealing range. This is also based on time and price. Where is the market trading in relationship with this time or this opening price? So right now, we're going to look at the absolute same thing, but our focus is going to be on the premium discount. Now, we're going to come back into this. Here, the market has successfully shifted. And right here, we can see that the market, with a trained eye, we can see that the market never went back into not even the equilibrium. And let me just give you an analogy to why this is important. So the reason why we as smart money like to buy below levels of sell stops is because we want to seek a discount price. The reason why we want to seek a discount price is going to be the following, and it is going to be best highlighted by a simple analogy. If I'm trying to go and buy a car from a car dealership, if said car is going to be at the price of $10,000, then what I would want to do is I would want it to be at the price of, $9,500. That is a discount of $500. So if I'm going to try and buy something, I would like to buy it at a discount. I do not want to buy it at a premium. And it sounds very logical, yet retail traders do this every day when they buy on a breakout. And if I am in the position of a salesman and I want to sell a car, if the price or the value of the car is going to be $10,000, then I'm going to want to sell it for $11,000, right? So it is going to be a $1,000 premium. This is how I profit when I sell, and this is how I profit when I buy. And smart money does the absolute same thing in price. Market shifts, and then the market does what? The market retraces back into this fair value gap. Our current dealing range is going to be from this low up into this high, and the reason being is because this low is responsible for the impulse price swing above this swing high. The market retraces, and once we have successfully formed the swing low and we have left this price action range, as we knew the fact that the market was creating this dealing range, this sell stop run, this run here with the sole purpose of repricing below this level of sell stops, this is the same thing. The market does this run for the sole purpose of repricing back into this fair value gap, making it balanced, and then we leave, knowing that the market is going to go to the upside. So therefore, if this fair value gap is balanced, and if we did not reach this level, then I do not even want to see the market go back below this level anymore. This is going to be a balanced price range. So why would we want to see the market go below this low? We never want to see the market go below this low because the market went lower. We made the fair value gap efficient and then we left it. We created a swing low inside of it and then we left it, taking on this swing high here. So this now becomes a balanced price range, dealing range. And yet again, this is another market structure signature without defining the real terms like market structure, of the market structure. Moving on, we're going to have from this low up until this high. And as we have reached a target that we were aiming for, we are now going to take this dealing range and we're going to anticipate or understand the fact that it is very natural for a price to be or to retrace back into a discount if we have reached some form of a liquidity pool or an inefficiency. The market eventually goes back into a discount, and the reason why we never care about this being a market structure shift below and then continuing lower is because everything that we've did prior to this lower time frame chart. So our daily narrative and our higher time frame premise makes us understand, because we never hit this level before and we have unfinished business above, this is going to be a sell stop rate. This is not going to be the market going back here, creating a market structure shift and then continuing lower. This is just a retracement back into a discount or an equilibrium price point. And usually this is some form of a fair value gap, and then the market is going to continue higher with speed using auto blocks inside of this expansion towards this highs, and eventually towards this standard deviation. And because we talked about standard deviations, let me tell you what a standard deviation is and how it is used. So if we are smart money and we understand that we like to buy a discount, then smart money, if they want to buy a discount, they're going to try and buy in down close candlesticks when the market goes down, right? So throughout this dealing range, every singular down close candlestick inside of this dealing range, what smart money did was that they bought. So therefore, if we are smart money and we're trying to trade for a profit, what is smart money going to do? They're going to want to double their money, minimum. So what is a standard deviation? A standard deviation is taking a fib from this low up until this high of the dealing range and then projecting this range and doubling it to the upside, or even tripling it, or even you can tenfold it. But basically, this range multiplied to the upside, that is going to be some form of a target. And again, this range, which was a manipulation range, and this is why we care about this, and this is why we deviate these ranges, because they're manipulation oriented. We can deviate these levels, and this was our formal level of target. This was our formal higher time frame key distribution level. So therefore, if we're going to look for precision or precision oriented trading, then what we're going to do is we're going to deviate some level above this. That's why it is called a standard deviation. This is not required for you as a trader, but rather it is for the process-oriented people. Process, not process, but rather precision. I wanted to say precision. Precision-oriented traders. And if this standard deviation and this standard deviation from this low into this high, and then from this low to this high, if these correlate and they get almost the same level, then what we will have is a high probability level to target for. And also you can also project this range here, and if we get the same level or in close proximity to it, then this is going to be a high probability target. The intermediate term low or the intermediate term high. The short-term low or high is a short-term low high, or the short-term low high is a standard swing high or low. An intermediate term low, which is the most important one that you have to know, or intermediate term high, but let's just use the intermediate low for the sake of an example. An intermediate term low, and of course reverse for the opposing, is a low that has a short-term high, a short-term low to the left, and a short-term low to the right. I made a mistake. I was thinking about swing highs and swing lows, and then I just written them by mistake like this. But basically, an intermediate term low, again, is a low that has a short-term low to the left and a short-term low to the right. And the most important thing that you have to understand is that this is also a swing low that rebalances an imbalance. The long-term low or high is a low that has an intermediate term low to the left and intermediate term low to the right. And yet again, let's go back to our curve depiction, in which we are going to understand, of course, I wanted to write down long-term low here. We have an intermediate term low here, and then the market goes higher. And then what do we have here? Market goes back into this fair value gap, and then we leave it. This is now again a balanced price range because the market has went back into the fair value gap, made it efficient, and then we left it. But this is also why this is an intermediate term low. This is why a low that rebalances an imbalance does not have to be broken until we reach this target. And if we break an intermediate term high, for instance, in an expectance of the market going lower, then that is going to be you being wrong and you have to get out, and that is going to be a sign for you to get out. Let me just say, for instance, we're going to have the market going lower here, and if we're going to be bearish, then we would never want to see this low, or this high rather, being taken. The reason why is because the market would have probably went back into some form of a premium, then it went lower, and this would be some form of a premium SIBI. So this would be an intermediate term high. But if the market goes above it, what happens? We had successfully did what? Shift from a sell program into a buy program. So this market structure shift, you now understand why this swing high is important and why we look at impulse price swings. So this is the most important one that you can understand. And then we have yet again an intermediate term low because the market goes back below a level of sell stops. This would be a short-term low, and then the market would create another short-term low, and then it's going to rally from it. So this is going to be an intermediate term low, which should not be taken because we went below a level of sell stops. And again, short-term low, intermediate term low, higher until this point. And again, I'm going to remind you that nothing will work without context, which will be learned integrally throughout month 2 and 3, and also 4 and 5. And this is an example that I want to share with you. If you recall, in the beginning of the video, I've showed you a 15-minute chart in which I talked about how the market would go below 2 levels of sell-side liquidity. So we have the first one, which would be the relative equal lows, and we also have the single low here. And what we see the market do is we see the market go back below both of these levels. This is our hard time frame sell stop rate. This here, the market went back into a CB and then we left it, taking on a what? A swing low. Because a swing low has a high low to the left, high low to the right. This is a swing low. It does not matter that the low is here. This is a swing low. Market goes lower. So this should have been an intermediate term high. But what happens is that the market creates a swing low after taking on a means of sell side. Market goes back into this small inefficiency and then we leave it. And then the market goes back above this high. So what is this? We were already anticipating the market to come back into some form of a key level from which we wanted to see the market reverse from, number one. And then two, the market shifted. So this is our first sign that the market has went successfully from a sell program into a buy program. What I'm going to look for in terms of targeting is going to be the following. I'm going to take on this low of the dealing range up until this high. If I'm buying on a discount, then what I want is to sell something, to sell my position instead of a premium. What do I target? A premium liquidity pool, premium fair value gap, premium fair value gap, premium fair value gap, and ultimately higher time frame market structure shift, or the lower time frame buy side liquidity pool, which is where retail traders would see some form of resistance, right? So moving on, market shifts, goes back into this BISC, quickly goes above it, continues higher into the premium relative to the dating range that we've spoken about. And also, I want to give you an example of some form of a discount in terms of price and time and not based on a dealing range. If we're going to look at the 830 vertical line, when we're trading here in the lower portion, when the market has successfully created the shift, when we're trading here, this is a discount because the opening price is here. The opening price at 830. So this is lower than the opening price, which means that we're trading on a discount. Market goes higher, comes back into this fair value gap, making a swing low, rallies away from it. So this would be an intermediate term low, which is also correlated with the fact that the market has failed this CB by closing above it. So therefore, by closing above this CB, we now know that this is an inversion gap. And because we want to see the market being strong, because we've also left these inefficiencies open, we would never want to see the market, or we prefer to not see the market into the lower half of this inversion gap, and would definitely do not want to see the market close below it or instead of the lower half of the inversion gap. So you can already see how these rule sets correlate between each other, because we've had the intermediate term low, market went above the swing high, and we've also closed above the inversion gap. Moving on, market goes higher, goes back into some form of a BISC, and then we leave it, leaving all of this as a means of a balanced price range dealing range, which means that after we go above it, you can see that the market never went back into it with deep retracements. Market did not even go back to this fair value gap. We fell short of it, and then the market expanded higher into our target. Now, for our standard deviations, if you would want to deviate something, it would be from this low up into this high. This was a manipulation leg. And you can also deviate from this low up into this high, again, a manipulation leg, or from this low up into this high, and you can get the same measured target above this higher time frame liquidity pool. And this was the video to introduce the liquidity pools and the market structure. I previously recorded this in the same manner that I've did right now. That was a 45-minute video, and I've deleted it by mistake, but it does not matter. And I hope you enjoyed this one, and I hope you gain some great value from this one, and I'll see you in the next one.